Hello, everyone. Welcome to GrowthVines. Thank you for watching. GrowthVines is a podcast where we'll talk about all things growth marketing. We will invite guests who are growth practitioners, growth leaders across companies, across several organizations, and several industries. And the aim is to learn from their experiences. Our first guest in the podcast series is Koustubh. Koustubh and I were batchmates at Accelerate, and post that we also worked at Airtel for a while. After which we went our separate ways. Koustubh has garnered significant experience in scaling and growing brands while at Amazon as well as at Mensa, and hence it made perfect sense for us to have him as the first guest of our podcast series. I will add him and I will let him share his experiences in more detail. Hi, Koustubh. Uh, you have been
Hi
added to
Arjo,
the
how are you
stage.
doing?
All good, Koustubh. How are you?
Great, great. All good.
Perfect. So,
Excited to be part of your podcast.
thank you, Kaustav. I am aware that you are on a tight schedule, so we will quickly start things off. Why
Sure.
why don't you just give some more context about your experience, so that folks can kind of understand where your answers are coming from.
Right. So yeah, Arjo and I have been batchmates at XLRI, and it's been what 12 years now, 12, 11 years, 12 years from the time that we passed out. And post our telecom experience, we sort of went in different directions while he was doing his work at Oyo. Uh, I got a chance to work with multiple brands across Cloudtail, Amazon, as well as the Mensa ecosystem for the last 6-7 years. This has been across categories like toys, personal care appliances, shoes, apparel, consumer electronics. I mean, yeah, I think I've done quite a lot of categories, and also had a chance to sort of evaluate multiple brands as part of the startup ecosystem as well. Yeah, so that's so initially from an Amazon perspective, I looked at these categories from only the Amazon lens, and then the last 2.5 years, while I was at Mensa, I was able to sort of evaluate them from an omni-channel perspective. So looking at D2C, various marketplaces, which marketplace works best for which category, and these kind of things. And I believe some of the discussion points that Arjo has up in store for this podcast is along those lines, along various channels, how they compare, how they you know what are the challenges, what are the positives, what are the trade-offs, those kind of things. So have had a chance to get a ringside view of those kind of things, and looking forward to chat on that, Arju.
So let's start off, Kaustav, probably with where you are right now and what you are up to.
Right. So I am in Thailand, in a small island called Koh Tao, which is actually known as the diving island, scuba diving island. And yeah, I'm doing some scuba diving for a good amount of time now. Actually, it's been 7-10 days, which might explain the tan that you might see.
Interesting. I obviously knew that. I wanted the viewers to get more context of where you are right now. Okay, so we will dive right in. We've already discussed the broad theme, Kaustav, of our discussion. So we will stick to that, and based on the discussion we have, this might go into a few other directions as well. So, Kaustav, you have worked across different categories and different industries and worked on brands to scale them. Uh, you have also helped scale these brands across the three different types of platforms, which is the own website of the brand, marketplaces, and also offline. With this experience in mind, if you think about the growth strategies, if you think about the growth levers, the growth mindset, uh, to what extent are these
Sure.
similar or different? Right? Are they really very different when it comes to thought process, when it comes to execution, or are these fairly similar?
Right, having worked across 5 or 6 different categories, what I can clearly see is that there are both similarities as well as differences. So when you're talking about a mental model or a sort of bunch of levers that are available that you need to work with, I think that is pretty similar. So the it's like a game that you're playing where the controls are very similar, but the buttons that you need to press are different depending on the category. So that's how I would sort of look at it. And let me give you an example. Two extremely different categories: consumer electronics and fashion. Having worked in both those categories, uh, I think they have a very different, you know, behavior when it comes to customer purchases as well as the unit economics of that particular category. So a smartwatch, for example, might be operating at a 30-35% gross margin, at a 20% return, and a certain 7 or 8 kind of a ROAS. These three variables are very important. So ROAS, so return on your ad spend, the gross margin that you have on the product, and then the customer returns that you are actually witnessing. These three together is going to determine the health of your P&L, or the bottom line that you're going to make. Now, this is very different for a fashion category, which is actually a much higher gross margin category at about 60%. But the ad conversion is not going to be as high. It is going to be probably 4, 5, 5.5, not more than that. It's a lower ASP product, ASP being average selling price. And then it's also a very high return product, because people generally try and buy, and sort of, fast fashion is where people feel very entitled to actually return products now and then. So now these two categories will basically, if D2C has to work out for both these categories, the levers or the input variables that you look at will continue to be these three things, but they will operate in a very different combination for you to make a healthy bottom line. So that's how I would see it. And this obviously varies from home, consumer, durables, consumer staples. All these categories will work out differently. So each category has a combination for which the unit economics need to be worked out. And this is with the assumption that that this is not a burn channel that you're looking at, a VC funded burn channel. You actually want the unit economics to work out, or maybe very close to zero at the beginning, so that you're not burning, but you're sort of just breaking even. You take a target bottom line and then work out the combination of these things and make it work. So yeah, that's how it's similar as well as different. And sort of, I think some category nuances also come into play, meaning that how dense is the competition in that category, how many SKUs are there, right? So is it a long tail category or a head heavy category? If it's a head heavy category, then you need to go all in on very small specific SKUs. If it's a long tailish category with a large selection of
Hmm.
SKUs, then probably you need to actually sort of select very few. Let's say if there are 500 products, you cannot actually invest on all 500 of them. You have to select a 20-30 portfolio which you think is your possible bestseller, and then focus all your ads energy and the initial orders energy on that kind of products. For that also, if you're having an offline business, you can get some surrogate of data. But yeah, we can go into category nuances as we speak through the conversation. But fundamentally, I think these are the three variables: gross margin, ROAS, return rate. And also over time, what happens is that you get a sort of loyalty from the customer. That's the fourth variable, which determines that what share of your sales on platform is organic and what is inorganic.
Sure.
So if you are having to pump 100% of the sales in an inorganic route, even 3 months, 6 months, 12 months after start, well, for starters, it means that the brand is not standing for anything, and there is question marks about long-term fitment of product, etc. But in the very short term, the PNL will never come out of a cycle. Even if you get 10%, 15%, 20% kind of organic sales coming through as you grow, that will give you a lot of leverage to reinvest that money and go for a faster growth trajectory. So I'll pause here. I think,
Understood.
does that answer the question?
Yeah.
Yeah.
So if we were to zoom out, Koustubh, and look at growth holistically across the three platforms, offline, own website, and marketplaces, do you think that based on
Right.
category competition, etc., there might be many other factors?
Right.
Is there a blue book or a template which you feel that founders might find helpful when they are planning to go after or build these channels? That okay, if you are at this scale, then think about building this channel, or build this channel first, or do not put your money in this channel first. Is there a template or a blue book which you feel exists?
Right.
And if yes, what are the various parameters or factors which affect them?
Right. So when you say three channels, you mean online marketplaces, offline, and D2C?
Yes, so basically online website, online third party platforms, and offline. Yeah.
Offline. Correct. So I think, I mean, with my limited understanding and on this topic, I think the opinion kind of differs across the board. So, I mean, I mean, it's quite possible that there is no one right answer. I think for me, I don't think there is one template or a one size fit all model in terms of which channel to go for first. I think there are two approaches that one can take. One is if you have very limited budget, right, and you want to try out, uh, you know, it's a kind of A/B testing where you try out all the channels in a very short pilot project kind of a manner, and whichever gives you the best traction, then you start doubling down investing investment on that one, and grow that to a certain scale. Probably try to get to a profitable amount of unit economics, and then reinvest their money into other channels. This is one way of doing it. And second way is also around what is your strength, right? Which is, uh, as a team, do you have the capability to navigate offline? For example, if you are a large family run business, for example, right, and you have interest in other categories as well, and you have an existing distribution channel offline, then despite the product, whatever be the nature of the product, the channel advantage that you have because of your distribution access, I think you should go for offline first. Secondly, if you are very savvy with sort of Google, Facebook, top of funnel, bottom mid funnel conversion, these kind of ad management tools, right, and you have proficiency in that, then your chance of success is probably more with something which has got to do with D2C, or maybe online marketplaces also to some extent, but definitely not offline. So I think your own sort of capability, skill set, network access that you have is a big determinant. Secondly, the product that you are trying to sell, whether it has a high awareness, uh, or whether it's a very highly competitive product or not, I think that makes a lot of difference in terms of determining which channel. Because if it's a product which does not have any awareness, then building that awareness right from scratch on a D2C website will require you to invest a lot of money and actually sort of bring traffic which may not convert. So you will have to invest significantly on education, and that education is something that one needs to be prepared to invest for. So your investment appetite, I would say, is another thing that determines this. Typically, marketplaces will have a shorter burn cycle, right? I mean, compared to a D2C website. Not always true, but 70-80% cases, generally, marketplaces will have a shorter burn cycle. But what do you lose? You lose the fact that, your products, you have not sort of built a brand on your own website. And tomorrow, if that marketplace decides to sort of arm twist you, or the fees goes up on that marketplace for some reason,
Yeah.
then you are at the mercy of that marketplace. So these are the factors, I think. So, and beyond the point, most brands prefer to get into a hedging setup, that even if you have grown to a certain scale with one channel, you at least want to have some other channel activated, so that you're not, unless it's D2C, which is the only channel, right? In which case it cannot be shut shop at anyone else's whims and fancies. But if you are growing through the marketplace route, then at least, at the very least, deal. I mean, spreading into two marketplaces or opening up D2C, these things should be done at some point of time. And sort of capability, investment appetite, hedging, and degree of competition would be the three or four variables that you should look at in terms of determining where to go first.
Right. Yeah. Kosta, would you also say that pricing and gross margin are two important factors which might affect this decision making? Because higher the gross margin, more the cushion a founder has with respect to the customer acquisition cost. So, is that also a serious input into this decision making?
Agreed. I think, is price a factor, or price or sort of the margin economics a factor in determining which channel to go after? Absolutely, yes. And broadly agree with what you just mentioned. I think what is implicit in the point that you made is that it's a non-funded founder, right? So he's trying to hold the unit economics positive or sustain this for a long period of time without external funding. If that is the case, then yes, you will gravitate towards the channel where you believe that you can sustain the PNL uh, or either sustain the PNL or get out of a burn stage the fastest. And typically that would mean marketplace for highly competitive categories, because there are already people searching for that product. What you have to do is to play the ads game smartly, bid on some generic keywords, long tail generic keywords, bid on some important your brand specific keywords, and some competition keywords, right? So a combination of all of that, you will not burn a hole into the pocket, and you will redirect the existing traffic that's coming to the platform into some of that into your brand, whereas that might be more difficult to do in a D2C environment. But also the flip side is that, I mean, true brand creation will require some sort of a you know uh, D2C scale up at some stage. Now, whether
Hmm.
it's going to happen at the 0 to 1 stage, it's not necessary. This journey needs to be done,
Sure.
not right away, maybe at a later stage.
Yeah, makes sense. Kaustav, one last thought before we move on to the next section. Marketplaces exercise a lot of control on customer data, whereas if you sell on your own website, you own that customer data. And for a young brand, it might be useful to generate customer insight, to understand repeat rates, etc., etc., and to dive much deeper into uh, specific consumer anecdotes. So that is sometimes critical for a brand to improve their product. Uh, so, is that something which a founder should seriously think about uh, and keep some sales going through the website, or is that probably not very important?
Yes, I think agree with both the points. Firstly, there is obviously going to be access to far lesser data if you go the marketplace route. Actually, you should see this as a progression. If you go through the marketplace retail route, which is the 1P route, you will have the least data. If you go through the marketplace 3P route, you will have some data, which is better than nothing. And if you go through your own D2C website, you will have the maximum data. But equally, I think the access to data is inversely proportional to the possibility of scaling, or the fastest time to scaling, I would say. So it's a mixed bag, so you have to see the whole thing as a combination, and figure out what works best for that use case. If you have the money and if you want to test out the first 100 200 customers, right, where you are not very sure about the product, or you're looking to fine tune the product, you're looking for a product market fit, you're looking
Hmm.
for customer insights, then absolutely D2C is the right channel, because that's where you will get the most authentic feedback, you will get the most authentic customer reviews, you can reach out to them, so you have full control. However, if you have a product where you think that it's not very highly differentiated, right, it's sort of, uh, let's say, a China generic in sorts of sourced kind of a product, in that case this might not be required. You can bypass this step and sort of directly show up on the marketplace,
Hmm.
and maybe you have cracked a better cost unit economics dynamic, right? I'll give you an example. So party supplies, for example, it's a commodity. So you don't need to do a D2C experiment on party supplies. You broadly know what people look for in the marketplace, etc. Now, for example, if you have sort of cracked a bundle of products which are very, very cost is going to cost undercut, or you have identified a few other use cases, then you can directly sort of build on marketplace and bypass. But a really authentic new product, yes, agree with you.
Got it. Very helpful. Perfect. Next topic which we wanted to discuss is a bit different. Is at which stage should a founder look at really scaling this up and look at fundraising, etc., right? At which stage, considering that the founder has some amount of money to bootstrap it till a certain stage, uh, at
Hmm.
what point, or rather what metrics should uh, point a founder towards fundraising?
Got it. So I think, as you said, so once you bootstrap, you try and get to a PMF stage. I think so. Very clearly, anything before product market fit is not something uh, that I would sort of encourage, or I would suggest, because if you don't have PMF, the problem is that once you raise the fund, there is possibility of using that fund for the things beyond scaling, right? If scaling is the primary objective, then you should not raise funds before PMF. If you have raised a small angel round to sort of try out the product, or create a first template of the product, get feedback from the first 100 customers, all of that is fine. But scaling money, typically a series A kind of round that you're trying to raise, that shouldn't happen before PMF. And I have also seen people put revenue anchors as PMF guidelines. And I don't fully agree with that, because what happens is across different categories, depending on the category size, percentage share of market, etc., you might get to the 20 crores, 50 crores, whatever be the number you are aiming for. But unless you make that a category specific number, it can be a false positive. So for example, in electronics, or a, let's say, a smartwatch brand, or in the case of a earphones brand, 100 crore revenue might be the number where you think that, okay, I have some degree of PMF. Whereas for fashion, that number might be a 25, 30 crore or a 40 crore. Within fashion also there are categories, right? I mean, there is a t-shirt, there is a leggings, I mean, depending on the subcategory. But
Sure.
unless you establish that number, and as a certain percentage of the category, that I take at least 1% market share of this category in a fragmented category, there is a chance to anchor to a revenue number, and that revenue number can go up and down depending on the category you are in. So that's definitely one. Second, I think most important is the customer feedback that has come in the form of reviews, uh, or verbatims that have come in, or some kind of a FGD that you have done, or some kind of a customer interaction that you have done. I think that plays a very important role in determining whether it's looking like a product which is just offering cost benefit or a value at the moment, and it is not looking like a brand beyond a point, or it is genuinely solving a particular problem or a use case which did not get solved, or which is not getting solved in the exact shape and form by any other competition in the market. So I think that's the most critical piece of information. And a combination of sales growth, the ratings and verbatims, and repeat purchase rates should tell us whether this is we have hit PMF or not. And all of this should be done at a not crazy burn rate, right? Because if you have done it at a very crazy burn rate, so the moment you try to shift the, let's say you are operating at a minus 20% bottom line,
Hmm.
at some stage you are going to bring this to 0%. The moment you bring this to 0%, the growth will just slide, right? And all of this will not work. So it should not be a crazy burn. Obviously there will be some burn, but it should be in a zone such that a 5 to 7% price change will be in the zone of tolerance for the customer, and you will not see customers slipping away immediately. So that's how I would see at the right stage for a PMF, and hence raising funds. The 4 points are: one is ratings and reviews, second, ratings and reviews, verbatims, etc. One is that. Second is the number of sales or the unit sales growth curve. Third is the repeat purchase rate, right? So these are the three metrics, and the underlying condition that I'm saying, or a gate criteria, is that it should not happen at a very crazy burn. Because once you have done a crazy burn, when you switch back to the standard unit economics, you might see a drastic drop off, and therefore whatever success you would have seen in this period may not be representative of the future growth. Yeah, so it's a
Sure.
3 plus 1.
Okay. So while this has been discussed to a certain extent in parts in the previous discussions we've had, but I wanted to talk about this separately as well. From a business perspective, Kostab, uh, what are the 4 or 5 factors which you feel uh, determine the failure or success of a brand scaling on its own D2C website?
Right. So I think the first factor is the product itself, right? So uh, is it something that customers really want? I mean, and this is the first factor of success, irrespective of whichever channel. You can fail. You can fail with a great product, but you will definitely not succeed without a great product for long. So a great product is a necessary condition for success, and typically what that will lead to is that people will convert out of ads. Once people convert out of ads, they will hopefully get into repeat purchases. So 3 to 6 months typically is the time that will be required for this cycle to kick in. And the moment repeat purchases happen, your organic share of revenue starts increasing, and that's how the flywheel kicks in. So the classic flywheel is that you start with certain sort of seed investment or a leap of faith, looking for a 3 to 6 month window where you are going to sort of expect 100% inorganic traffic. So all you need to do at that stage is just ensure that the ROAS that you are operating at is not crazy, and it makes some sense, and you have a target bottom line that you are operating for the 0 to 6 month period. You stick to that target bottom line, and you get the ROAS, you get some scale, and then the moment you hit the 3 to 6 month mark, 2%, 4%, 6% organic share starts kicking in. And the moment it increases, and that organic share will only kick in if you have a great product, customers love your product, they refer or they repeat purchase themselves, then the flywheel kicks in and you sort of start getting a tailwind which pushes your growth journey. So I think that's the key aspect, because many brands sort of spend a long period of time without getting that organic share coming in.
Hmm.
So you are burning, or you are sort of head out of water, or -2%, -5% kind of a margin, and you're doing this for 6, 12, 18 months, and you don't have a exit point. Why? Because repeat purchases are not happening, or
Yeah.
organic share is not increasing.
Sure. Uh, Perfect. Which brings us to our last segment. So as you are probably aware, Kaustubh, that at Yes to Growth we work with many early stage founders, and at Mensa also you have had the experience of working with many early stage founders. You have surely had discussions with several of them, and maybe ended up working with a few of them, depending on how many Mensa ended up acquiring. Yeah. Uh,
Right.
so when you discussed with them about their growth aspirations and the problems they face, which are the common themes which you found kind of came out from those discussions? That what are the problems they generally grapple with while they scale up their brands?
Right. So, I mean, having had the chance to interact with multiple founders across categories as well as across sort of different working styles, different geographical location, I think it's very hard to sort of say that, these are the unique problems. I think founders generally will have a long tail of problems as well, or things that they are looking to specifically solve for their brand. Having said that, I will try to talk about three or four themes which have recurringly appeared across my interactions with founders. So I think first is capital, access to capital, because access to capital gives you the right to sort of play more aggressively, or take a more riskier bet for growth, which currently they are not able to do because they have to protect the house. And that may mean that they lose out on an opportunity of growth, because that category is showing high growth, may stay for 12, 14, 16, 18 months. And if they're not able to participate right now, what would happen is somebody else will get that growth. So access to capital is a key ask, or a key requirement. Second is, as I was saying, so founders generally are good at sourcing or sort of creating products. At least they would have nailed one product or one category well for the brand to have come to that stage
Yeah.
itself. Now, from this stage to the next stage, they need, sometimes they need just more channels, more geographies, and more products, right? These are the three possible levers of growth. And in all the possible aspects, they have some opportunity of growth which they're not able to crack by themselves. For example, channel. Many founders are good at offline, but they may not have the right network in the marketplace ecosystem, or they may not understand the nuances of D2C fully. And that's where organizations like yours can help them scale online. And that's where there's a key need, that I have landed the product correctly, my product is successful offline, here is my proof of success. but I don't know how to play the online game. There are online unique customers, incremental customers, which I should be getting access to. If I can play this game, can someone help me scale and grow? That's
Sure.
the use case that you are solving for, and that's definitely a strong use case that I have seen come across. Third point is around geography and product. So product development itself, you know, structurally being, certain businesses require you to structurally be able to come up with products at very high frequency, good products at high frequency which are in line with the market, and they need to be timed correctly. If you miss it by 3 months, 6 months here and there, then the launch will not have that bang. So, how do you create a strong engine for continuous product launch, new product launch? So, which means that you will get great insights from the marketplaces, you will get insights from the customers, you will have strong network with factories, whether it's in India, in China, wherever the sourcing of that category is happening from, and you will bring new products at a continuous rate to the market, where your bottom side or your downside needs to be protected to some extent, that you cannot have, I mean, you cannot have five flop launches and you are out of the business, right? So you have to have a hedge to the downside, but equally you have to play the game in a manner that you keep on launching new products, or add categories that help you grow the brand in the adjacent category. So this has been a common theme, that how do I sort of have a continuous engine for growth and continuous engine for product development. Third, I think scale versus profitability. Like, what do I go for earlier, right? If I go for profitability, then I'm probably missing out on an opportunity. I will not be able to present an exciting business case to a VC for funding. But if I go for scale right now, I burn my money. And then if I don't get funding, then I actually don't even have the opportunity to run the business on my own as it was running,
Yeah.
right? So that's also a trade-off choice that the founder needs to make, that whether they will go for the bigger scale or they will go for a sustainable profitability, so that they don't need to raise to survive, they need to raise to grow, right? And lastly, I think low stickiness, right? Or which we touched upon on the other part, right? Organic share of purchase, low stickiness, lifetime value, how many purchase repeats are happening. So I think these kind of metrics are some things which founders uh, love to track, and people who are evaluating founders from a funding perspective also like to track, because that is the early lead indicator of any kind of a brand awareness, or anything which sort of remotely looks like a brand. So yeah, I would say these are the sort of three or four things that I've seen sort of recur across different founder types and different category type topics.
Perfect. Extremely helpful, Kostav. Thank you. Thank you for sharing this. Thank you for finding time. This has definitely helped me. I'm sure it will help all the folks who will kind of view this